Greetings, everyone. Welcome to Top Trades. We are live here. It's about a minute till 11 a.m. Eastern. I have very aptly named today's call Top Trades Live without Greg Guenthner, but with Alan Knuckman. Alan, greetings.
Hello, hello. You still can't say Greg's name correctly, can you?
Guenthner.
Yeah, well, there's a lot of that in our company. I mean, Dave Goggenham, I still can't pronounce his name, and I've known him for 20 years.
We had a question. Now, look, if you're joining us right now, we're going to do a little bit of warm up here while we wait for everyone to pop on the call. We're live here on YouTube. Go ahead. You can write into the comments. Let us know where you're from. Say hi. Let us know if there's any tickers you want to cover. And if there's any questions you've got, go ahead, throw them in there. One of the questions we had earlier today in Gunner's paid letter, the trading desk, I think someone was asking, you're up in Marquette, right? Sometimes when you're in the UP,
Yep,
you're in the Marquette area.
you betcha. Hey, so yeah, I'm
Yeah.
in the Upper Peninsula of Michigan. Now, if you're from Michigan, you do this, so you can
Yeah.
tell like where you're from. And most people just do this, but there is an Upper Peninsula who was actually won in the Battle of Ohio. Now, you ask a question. Be careful if you don't know the answer.
Here we
The
go.
Battle of Ohio, no actual gunshots were fired, but not mercenaries, but militias did line up on the border of Toledo because Ohio wanted Toledo, and so did Michigan. I'm not going to say anything here. So they settled it without any gunfire, and they gave Ohio Toledo, and they gave Michigan the Upper Peninsula, which happens to be, how many trillions and trillions and trillions of dollars worth of resources and commodities, copper, iron, timber, so
All
I
right.
think
At
someone
least we're
lost on
back to
that.
commodities there. Other thing, this was gonna be like top Michigan history live. We gotta watch out for that one. That's a whole separate YouTube channel.
No, that's
Um,
because it does come all back to commodities. If anybody knows me, that's everything has a comeback to commodities. And that's, I couldn't be a greater example of that. If you look right here in the lake, you're going to see ore boats go by with iron ore that made America.
there we go. All right, we're back on here. Now look, Gunner is not here. He will be back next week. We'll be rocking and rolling or whatever. But normally Gunner has like some little sheets and stuff. So I got mine. I've got a little printout because I gotta manage the charts. I got a bunch of tickers here. What we've done, Alan and I talked in the green room. He's got a bunch of tickers that he likes. He's got his top trades. So we want to go over a bunch of those. And the sector shouldn't surprise anyone on some of them. We're looking in the commodity space. So we'll cover that. We want to cover some of the recent winners that you've seen that you've recommended, Alan, because again, we've got a lot of different analysts here at Paradigm Press, but you've been knocking out of the park. You got a bunch of 100% winners recently as well. So we can go over some of those tickers, kind of what you were seeing, and see if any of them are still, something you might not officially recommend, but maybe it's still a buy or something to look at.
Okay.
And then some of the other stuff we wanted to talk Palantir. We were talking about in the chat earlier. It's a stock that I hold, so it's something we might cover there. Some other tickers, anything that comes up out of the Q&A here on YouTube as well. And then if we get to it, we could talk big picture stuff, sort of how you think of money management. And then there's a conversation in the trading desk. We were talking not only about where you were from the Upper Peninsula, but also a lot of people talking about meat for some. It was like Fogo de Chao, some meat restaurants. And then if people don't know this about Alan, like you should know, Alan owns a meat company. It's a barbecue chicken company. So we're going to talk about that one too, because
But
we're
that
getting
comes back
close
to
to the 4th of
commodities.
July. You got to know about this special cut of meat.
So, right, but that all comes back to commodities. The way I came up with it was studying corn grain hedging. All right. So the price of corn obviously impacts the price of your steak or your chicken. It takes 2 pounds of corn to make 1 pound of chicken. So I would ask, corn ranchers, farmers, whatever you want to call them, what they were doing when corn prices were high, if they were hedging properly, because that's their major component. And so I realized there was opportunities in the chicken business because of the commodity.
Yeah. All right. Well, let's get into it. I'm going to go ahead and share my screen. We're going to start throwing some charts up here, and we'll talk through some of the ideas that Alan has and where we go from there. So let me share my screen. All right. We're rocking and rolling here. in my version, this is not Gunner's. Gunner probably has some special, super expensive version of TradingView. I have the regular one. This is still paid, but it's like
Hey,
a
I
normal
know that
human.
I know a guy you could ask to maybe get a little bump up in the service.
Yeah, I should ask that guy. So whatever that is. All right. Well, Alan, you had three trades. When we're talking top trades here, you had three that were right off the bat. You wanted to talk SLB, silver, you want to talk
Yep.
FCX, and you want to talk SLB. So we've got the chart for silver up. Give us the rundown. I mean, again, get people caught up. Why do you like silver in
Okay.
particular this ETF?
All right. Well, we got to back up. Obviously, the stock market's been super strong. So for me, I'm a trader. I'm going to trade whatever the opportunity is. That's what I do. I've been doing this for 35 years. Okay. My original background was in commodities on the trading floor at the CME Group and so forth. But
Yep.
I'll trade anything at any time as long as I can control my risk and take advantage of whatever the opportunities are. Now, looking at the markets, we've come a long ways, and stocks are expensive. Not to say they can't go up a lot more, but they're expensive in terms. We've got the Nasdaq up 75% off its lows, and we've got the S&P 55% off its lows. So, the risk reward's not there. Where the risk reward right now is commodities. And we've talked about the commodity super cycle. And that was my speech, I think, the last 2 years at our paradigm events
Yep.
each year. And that's where I see the opportunities the most from a risk reward standpoint. Now, if you look at the markets, if you look at commodities in general, there's something called the Commodities Research Bureau Index. We're at the halfway point of the high to low from the last 20 years. So whereas stocks obviously are up and away, I think there's great opportunities in our commodities, and we're kind of in an everything bull market right now. Part of the equation is the dollar going down, and we can talk about that as well. I'm sure we will, but I just want to trade what offers the best opportunities. And the way I trade is I follow the charts like Greg does, but I also have a money flow indicator that keeps track of where leverage buying is going. And so I follow the smart money, and that's been very successful for my profit wire service over the last 5 years.
Yeah. All right, so let's talk us through. Do you want us? I can bring up the dollar chart, or do you want to talk us through why you like, in particular, you like commodities, you like things that are kind of the dollar starts topping out
Right.
here, or whatever. You like silver. Do you want to talk through this or any other?
Sure.
This a good
Sure. I
place to
mean,
start?
we all know gold. We all know gold's making new highs. Now, when you adjust gold, the 2008, what it was, the 1990 price for inflation,
Yeah, then
you
probably 1980, right? Like 1980,
1980, I'm
whatever that
sorry,
high was,
was that
800.
spike high at
Yep.
$800. If you adjust that for inflation, we'd have to hit $2,700 to make new highs. We still actually haven't made new highs. But gold right now is finding a huge base at 2,300. And so that's a huge support level. And we're looking for that to hold. Same thing with silver. Well, there's gold. You can look at that. We've been trading between 2,300 and 2,450. When you look at gold itself, we're making a sideways pattern, and it's a stair step. We've seen a lot of stair steps, a stair step in stocks, stair steps in commodities as
Yep.
well. So, gold has upside potential, obviously, but it's already at its highs, essentially. Go to silver. Silver, on the other hand,
And I'm going to pull up
has,
the ETF. This is where we wanted to be. So
okay,
again, this one's not silver, the commodity. This is the ETF,
it's
but
the
it's
ETF.
a
And
spot ETF. Yeah.
that's one of the reasons we're doing today as well, because a lot of people need to know that the evolution of the markets now, when I was a kid, you had to trade the straight commodities, and that had, different concerns. Now you can trade ETFs, which are exchange traded funds, on essentially any commodity you want: silver, copper, corn, wheat, whatever. There's a ETF, oil. There's an ETF that tracks it. So that means we have access to those opportunities that we never did. And so for me, this is the best time in history to be a trader, because there are unlimited opportunities. Unlike when I was a kid, you could trade this or you could trade that. You didn't have the availability like we did. All right, so let's get to silver. Silver broke out, and if you look at it, we've been roughly between 20 and 30. So there's key support at 25, but we've come back to that breakout point of a couple months ago. And so, this is a level to lean on. We're seeing some profit taking, and silver, if you adjust the 2011 high of $50 for inflation, it would have to get to 69. Now, that's twice of what we are right now. So from my standpoint, I see a lot more upside in silver. Obviously, silver and gold are different, but there is a connection there.
Yeah. I mean, I'm just looking at the comments now. Look, this will show you every now and then I'll just read anything that'll show up in the comments. But someone wrote in, a wise old investor told me years ago to stay away from metals and commodities. What? Who is this person? Wise? I don't like that.
Okay.
What do
All
you have
right.
to say
Well,
about what if someone told you as
I
a
have a
as an adage to
whole
stay
list.
away from metals and commodities?
I have a whole list here of myths, mistakes that smart people make about commodities and resources. Number one, we're trading ETFs on the commodities, and you have limited risk. I'm looking at limited risk options, and I'm in the money options that are going to act like the stock. Number two, so how I trade is equally important as what I trade. So I've got limited risk. I do not lose any sleep over my positions. I'm buying 3 to 6 months of time. I don't have to watch the markets day by day. It's a myth that people think that commodities markets are for short-term trades. You could have been in the E-mini S&P for the last 6 months and just made money and just never even touched it. You could have done the same thing with gold if you so choose. So it doesn't mean that you have to be a short-term trader. And for me, it's about controlling risk. Like I said, I'll trade any market, anytime, any direction, as long as I can get in smoothly and get out smoothly. Nowadays, you can put a stop loss in on your options. You can put a stop loss in on your commodity if you're actually trading that. And those markets trade 24 hours, but we're not doing that. We're trading in the stock market, and we're using ETFs as long-term vehicles to take advantage of what these markets have to offer. So,
Yeah.
the game has changed. The insiders had an advantage in commodities 20 years ago, and that's why I was on the trading floor, because I had an advantage. Nobody has advantage anymore, and everyone has equal access to these opportunities. So the game has definitely changed. But you want to trade what has the best price moves and the best opportunity, and that's what I do.
Yeah. Let's give, I don't know where this one's going to go, but let's give the people, you were in the commodity pits, right? And you've
Yep.
told me you went through, like you were there. And then at some point in time, someone's like, hey, that guy's pretty tall. Get him in these pits or whatever. Any good stories that I haven't heard or something I've already heard? Like, what's a good story from back in the day when you were in the pits? Anything crazy happened there?
Crazy, yes. It was crazy every day. It was, but you know what? It's so much better now, and it is so much better now. You can at a click of a button. You don't have anybody sweating on you, spitting at you, yelling at you, pushing you. You don't have any of that. You click a button, you get into a trade, you go have your drink, and then you wait. You let the markets do the work. I don't
Were
have
those
the work.
guys like the guys that were in the pit? Were they friends with each? Like, did they hate each
Yeah,
other in the
well, I would
pits,
say,
and then they went out and drank together afterwards?
oh yeah,
How was the
oh
setup
yeah,
there?
yeah. But
Or
they
were
were
they angry?
frenemies.
Were they like, oh, I hate that guy?
Well, there were some guys you hated because they weren't, how should I say, as ethical as you needed to be. So the guys on the trading floor weren't great traders. If you want to know the truth, they were successful because of who they stood next to. If Goldman Sachs stood next to you or JP Morgan stood next to you, you could provide an edge for them, meaning that you could buy at the bid and sell at the offer. So you did that a couple, dozen times or 100 times a day. That's how you made your money. You weren't a trader. You were just providing a service. You don't need that liquidity anymore. We don't have that
Yeah.
necessary anymore. And anybody now can be Warren Buffett, whereas Warren Buffett obviously would move markets before, and he had special access and traders had special access. But the game has dramatically changed, and it's just it's capitalism at its finest. That's how it works now.
Yeah. And a lot of these things, again, knowing what vehicle you're in, we know you like options and,
Mm-hmm.
the different ETFs are they trade differently, but the ones like you got SLD or, GLD or whatever, those are spot ETFs. Those are going to be, you can, like you're saying, you can kind of sit in them. If you think it's going to hit
Yeah.
all-time highs, you won't get churned up with fees or anything like that.
No.
Now, some ETFs you can, if they're rolling futures contracts, you got to watch out for that. But an SLV, you could just sit there and watch. If you think silver's going to go, back to $50 or whatever, you just sit in that ETF, and it's an easy way to play the base metal there, and
Right.
it comes.
I'm looking at January options in silver, the January, 25 calls. It gives you the right to be long from 25. 25 is an important midpoint here of the range for the year. And that gives you what, 7 months of time. And what I always say when I trade options is, options, you can exit your option at any point. If things aren't moving your way and the option loses half of its value, either you're running out of time or the market hasn't moved to your favor. So you could pitch it out and say that's that. You have absolutely limited risk. And most important at my age is I want to sleep well. I don't want to get up 3 times in the middle of the night like I used to when short-term trades. I just don't want to do that.
Yep. All right, we got your next ticker up here. We got FCX up. Now this one, I know folks in the trading desk, we had a trade on that with Gunner. And then, recently we've seen a little pullback. You had a nice little run up
Yes.
there, consolidation run up to 50, 55, 54, and now it's been pulling back a little bit. What are your thoughts here? What do you like?
Profit taking pullback. Let me say that again. Profit taking pullback. So you make money, you want to sell too soon. And, we saw where people did that. Copper itself went from 375 to 525, all-time highs. Now it's pulled back to the 450 midpoint of that. And you're going to see the FCX went from 35 to 55. So the midpoint is 45. So I'm looking at a 45 call for September, has 3 months of time. It's in the money. And you're seeing money flow back into this sector. That's been very, very positive. And so let's see the next leg. You want to be, obviously, this isn't new to anybody, but buying dips, selling rips. It's all about money management. We'll get into that as well. But, this is the way I like to trade. I call these lifestyle options because I live my life and I let the markets do the work. I don't have
Yeah.
to stare at anything. I look at things on a weekly basis, and kind of evaluate what positions I have. I've limited risk, and I sleep well doing that.
Yeah, that's a good thing to distinguish too. You do have a lot of times you and Gunner will have some similar trades on, but you do have a
Right.
little bit different time frame because his are normally a little tighter. He's normally only about a month, maybe two out. You're normally three-ish, but that's a good way.
He's,
Like that trade you got there,
yeah,
like you're looking out to September. Right now,
yep,
a lot of people could say, like, oh, well, it's short term, it's pulled back. But like you said, you got to add 3 more months on basically to get us to September. All that thing has to do, depending on what pricing you got in at and stuff, go back towards that 54, 55, and you're sitting pretty and you can wait
huge.
for that to happen.
Huge. Yeah. So
Yeah.
that's the idea. Gunnar and I are very similar in the fact that he's younger and he's a better trader. Now, I don't mean that to disparage myself, but he's a better trader. I don't consider myself a trader. I consider myself someone who uses options as a vehicle to take advantage of what the markets have to do. So I'm going to buy enough time to be right. And I'm going to buy in the money options that are going to act like the stock. Okay. So it's not rocket science what I'm doing. I have the better way to trade, is the way I look at it, because I don't have to follow the markets minute by minute or day by day. Gunnar has to make decisions. All right. I've taken myself out of the decision-making game because I'm buying deep in the money options. His are sometimes, are at the money or maybe even a little bit out of the money, and he might buy a
Yep.
month at a time. So he's got to make a decision if he doesn't get the movement he wants in the next week or two because of the way the options function. Whereas I've got time to let things happen and develop. So mine's more of a lazy way to trade because, like I said, I got a lot going on in my life. I got things to do, but I'm making the markets work for me.
I saw a video of you on, well, it was just a text message, but Alan's like driving around a Jeep in the beach. It looked like he was like
Okay, now
off-roading. This was Father's Day. I guess you get a pass. You can do whatever you want, but it was like some sort of
let
Yahoo
me tell you what
situation
happened.
going
I
on.
wasn't abusing the ecosystem, if that's what you're implying. What I
Yeah.
did was I was trying to bring a jet ski down to the beach, and no one was there to help me. So I thought, you know what? I'll just use the Jeep. I'll pull it down to the beach. So I pull it down there, but my dog ran in front of the Jeep. And, if you're driving a Jeep on sand, I don't know this, but you got to keep moving.
Yeah.
If the tires stop moving, you're going to get stuck and swamped. And so what happened was the Jeep got swamped, and now I know the vacuum four-wheel drive unhooked itself. So I had to, figure that out and then run back up the hill. So that's what I
All
was
right.
doing.
By the time we get to the end of this call, I'll figure out the analogy for that of like you got to keep the wheels moving and tie it into options and investing. It'll be
Right.
great. All right, let's
Yes.
bring up the next one.
Momentum.
You
It's
got
about.
S.
It's all about momentum. I'm a momentum trader. It's all about momentum, and Greg is too. He gets it. Momentum is serious. You don't want to fight momentum. I'm another part of that. Here now, you keep bringing this up. You keep making my life easy, but the way to focus on that is that I'm not trying to be the smart trader. I'm just trying to not be stupid enough to think that I can pick the top or the turn in any of these markets. I'm trading the overall market momentum. That's what I do. And I use options and I have limited risk.
Yep. All right, let's look at your next one. SLB, that's Schlumberger Oil
Yep.
Services. What do you like here?
Well, you got to look at a 5-year chart here.
All right, let's
Okay.
do it.
So this is risk reward. Okay. And, part of this equation is everybody's concerned about inflation. If inflation rears its head again, there's money to be made. Inflation's not necessarily a bad thing if you make it work for you. Inflation on most people's houses have increased the value of everybody's house, and that's the number one asset that everybody has, and that's a leverage asset. You put down 10%, and you've just gained a shit ton of money, in the value of your house. Okay, so
True.
inflation. If you look at oil finally broke out above 80 again. Oil's been between 65 and 85. A breakout of that 85 for crude oil itself sends it to 105. I know someone's going to say, and I'm listening to Dan Amos right now, one of our other analysts, say that high oil prices hurt the stock market. Well, yes and no. High oil prices sometimes can be a sign of demand and market strength and economic strength. And actually, from 2011 to 2014, the price of oil was above $100 or at $100, and stocks rallied 35%. So, anyways, if you look at this 5-year chart, we've come back to a super support point in Schlumberger. You look at the last 2 years, you can see that we're right there at that important old high from, I can't see this, I don't have my glasses, that old high from 2021 or something like that. Which is now
this one, this little guy?
No, this one up here. Go forward. No, other way. That one. That spike right there. So you can see we kind of come back to that. Yeah. And so that should act as a support level. We're also seeing leverage buying in this. We're also seeing bullish divergence is something I look for, where it's making new year lows but not new highs and implied volatility. And Schlumberger, the volatility is low. Again, you haven't heard me talk anything about any of the fancy Greek things in options. Volatility is the only thing we're going to talk about because, again, I'm just a simple trader. Volatility is the ability of a stock or ETF to move, all right? The higher the volatility, the more movement. But if you look at something like Schlumberger, the volatility is ridiculously low. It's at half of what it was for most of the year, meaning that the options are cheap in relative terms to what they were before. That's a very positive sign, because if the stock's making new year lows, you think there would be more fear. There's not. And so that's usually a sign of a sentiment shift. And with lower volatility, you're able to buy more time. So instead of buying a 3-month option, like we did, and we were looking at an FCX, I can buy a 6-month option in something like this and be in position for success. That's the way I look at it. But if you don't believe that, I don't think there's anybody that's not concerned that energy prices can't go higher. And I think energy is a sector, that's the one sector that really hasn't participated in this rally. And the key is yet. We're down here with crude oil, not rallying, but a lot can happen very quickly in that market, as we well know. And we've traded Schlumberger, Halliburton, Occidental. So a lot of these oil stocks, when you look at the oil sector, it has been the one that is the cheapest if you look at PE. PE overall for the stock market's at 20 or something like that, right? I'm sorry. And if you look at this sector, the PE is down at 8. So these stocks are cheap in real terms.
Yep. Yeah, I got crude oil, this 1-year chart up. Again, it's looking constructive. And Schlumberger, the oil service guy.
You can see. Can you do this? Can you do it's a giant wedge.
I'm not putting the giant wedge on there. I'm not. No, everyone starts realizing how dumb I am. And if I go over here, there's all the emojis. If I do the emojis.
No, I don't. I'm not that guy. Greg's that guy. I'm not that guy.
No, that's me. That's the problem. That's why I can't start.
You do that?
I can't start doing it.
He did that. You're the one that's just toying around, clowning. That's clowning. All right.
All right, let's move on. I said this in the beginning, but let's talk about some of this. You've had some winners in some of the trades that you've been making over the last couple of weeks. I want to take a look at some of those just to see if there's any juice left, if you still like anything. Let's bring out Hewlett Packard. You had 100% winner on that one. I mean, HPE. It looks like.
Yeah.
There we go. That's looking good. That's a 1 year. I think I got up there. Maybe I'll go down to 6 month or so, but yeah, I mean, 6 month, that thing's looking good. And that was you guys just took gains on that last week?
Yeah, just last week, 100% gain. And that's my strategy, is that, again, I don't want to think. I want to trade what I see. And part of my discipline is money management. And we've updated the targets that we have because we've had so much feedback about our 100% winners, that I was taking half of the position off at 50% gain and then taking the second half off at 100%. So right now we're going to focus on 100%. Now that sounds like a lot, and it is a lot, but the way we trade these in the money options, you need a 10% move in the underlying stock. And what was that move right there from, for when that gap and go, how much is, I can't see, do it move from what, from there? Yeah. To the,
17 up to 19, and now it's at 22.
okay. So it went from 17 to 22. So that's $5. That's more than 20%. So again, a 10% move gets us our 100%. Yeah, we sold too soon, but that's my strategy. It's about identify, execute with money management, manage the trade to maximize the trend, and then repeat. So I'm going to take my money and then I'm going to look for new opportunities. And that's how I approach the markets. Look at, look at KMI. KMI, we are in May, we took 100% on that. KMI, which is, look at that.
Yep.
Kinder Morgan, which is an energy stock, a pipeline stock. And so, that benefited. I saw the money flow. I saw the triple bottom, so we positioned there. Obviously, we left money on the table, but, I'm okay with that. At my age, I'm not trying to hit a home run. I'm not trying to hit the lifetime trade on every single trade. I'm not, this is not gambling. This is probability. It's about the ability to repeat this and do this again and again and again. So, that's a commodity stock. Let me just grab another one here. BEKE. All right. And this was a sector that nobody liked, but again, I trade what I see.
KE Holdings.
Yeah. It's KE Holdings, well, look, we took profits on that in May. Again, that's part of the strategy, sell. And now maybe it's come back to its breakout point. Maybe we'll look at it again. But that's why you want to sell too soon. But look at that move. And this was a China stock. Nobody loved China except for
you, Gunner,
thank you.
a few people.
Thank you. All right. So, it was a China and a real estate stock. So if you think about it, you're probably not going to take advantage of that opportunity. But if you see what you like in the charts and you're the right indicators and the right risk control and the right vehicle, you can take advantage of any situation. Again, I try not to think too much. Thinking gets me in trouble.
Yeah, so Baba was another one I think you guys had in the China trade.
Look at
it's
that.
a similar thing. It's pulled back since, but
it's
you guys got it
down.
on the
Maybe
substance.
now Baba's a second chance play because we've come back to that breakout. And again, like we did in silver, silver setups come back to its breakout. So, you got to buy the dips and sell the rips. But unfortunately, most people don't have the right psychology. They wait for the breakout to happen, then they jump on board. And when it doesn't follow through, then, your leverage is gone. So that's what I was going to say.
All right. And the other one you had was Corning, GLW. Oh, that one's looking good.
Yeah. I got out too soon. Sold.
All right. Let's talk Corning and Hewlett Packard. Those things are just rocket ships. Do you ever think about, like, on a trade like that, would you ever get back in, or do you have to have it reset up because it's otherwise just kind of sky high?
Yeah, I'd have to reset it up myself personally. That's how I trade. Not everybody's going to trade like I trade. I'm boring. Boring for me is fun. I've done the active trading, okay? It's not nearly as fun as you think it is. You can't even get up and go, you drink your iced tea, you can't even get up and go pee. I want to, like I said, let the markets work for me, think big picture. Now, look at a big picture, pull up a 5-year chart in HPE. There's probably still some more upside left, but, it's gassed. I mean, it's made a big run. All right, maybe not. Well, yeah, it's broken out. And, I would find something else. There are unlimited opportunities. I'm never going to buy the low and sell the high. That's not my game. That's not what I do here. And I'm not a gambler. I hate gambling. It's all about probability for me.
Isn't it? All right. I'm going to stop my share for a second. Isn't it true? I say this as something to just keep everyone's mindset in the right way. You can never sell at the high, right? Like if you're going bid ask and you actually sell, normally it's not you getting, like, you're not ever going to be able to. The only way you can get the high is if you buy it, right?
Typically, as an off the floor trader, typically, yes.
Yeah.
But the beauty of why now I say it now is the best time in the history. Number one, you're not paying commissions, okay? So that for a lot of people is danger because they overtrade, okay? Most people are bored by my long-term stuff. But guess what? I'm about making money. Trading is not what's fun. Making money is what's fun. I can't say that enough.
Yeah.
So
One thing I could
or
say, yeah, we can
but
get to
now
more
I was going
ticker.
to say the other thing is
Go.
the spreads are really tight. That's what I don't want. I want to tell you the spreads are in pennies for stocks, and for options they're like 5 cents. So you can get in when you want, get out when you want. And there's tight markets, very tight markets. That's much different than when I was a kid. The markets were not efficient like they are now, and that's why the traders would made all the money.
Yeah. And you would still say, like, because I do agree, most options now, and especially over the last 10, 15, 20 years, like they're way more efficient. But if you get into an option that is not efficient, are you trading that? Like if you see a bid-ask spread that's like 30%, 20% of the option price, are
I
you getting in
I
that thing?
myself personally only trade. I mean, unless it's no, I'll only trade big name stocks. Okay.
Yeah. And those are
And
always going to be pretty much tight.
they're always going to have tight bid ask spreads. And if the spread's more than 20 cents, split the difference. Okay. And then see the spread change and then split the difference again until you get in. Don't chase it. If it's a wide spread, 420 at 490, put it in the middle, wait for it to come to you. And if you don't get it, you don't get it. Don't chase. I know
They call
it's
me
easier to say. I know everybody wants to get that trade, and that's just, it's all about psychology. It's all about psychology. And I've seen, just looking at your face, I know what you're going to say.
they call me market order Matt. What? What do you
I
want?
wasn't
What
going
do
to
you want
say it.
from
I
me?
wasn't going to say anything
All right,
disparaging this whole phone call.
let's. Oh, one takeaway. Alan said it, and you went through that pretty quickly, but I want to make sure everyone at home gets that as well because we got a lot of traders on this call. We're always trying to get better. We're trying to get more experience. We're trying to learn from how we are naturally as traders and up the level. You heard what Alan said. He changed his strategy. He had a strategy where his plays were a little bit more on autopilot, where if you hit a 50% gain, you take it, and then you hit a 100% gain, you take it, and by then you'd be out of the trade. What he realized through a back test is, if you just take away that 50%, you go first stop is at 100%, and you look at it. So that's a way to like take a look at your own trading over a time period and say, what could you have done better had you changed a few of your rules? And Alan saw that and he realized, we should just go for it. A lot of these trades. And it's been said around the office. I've heard it a couple different times from writers, researchers, right? Alan has really, really good stock selection. He's picking stocks that are in this area where they like to move. Sometimes they're bottoming out. Sometimes they're momentum plays. And that stock selection, you really want to give yourself the chance for those 100% gains on the first leg of that trade. So that's something he's doing that everyone at home should be doing, right? If you're learning to be a better trader, you look at what you've done over the years on your losses or where you didn't make as much money as you thought you should have. And I'm not talking about just guessing and hoping you get out at the top. I mean a strategy. And that's something that Alan's doing. So let me share my screen again. We're going to go back in. This is another one you told me in the green room. So we will see what's happening here. Wheat. We're going wheat. Look at that. 5-year chart. Wheat is basically free.
Yeah. All right. But go to a 1-year chart. And you can see how
Yeah.
it bottomed out. And we were trading between 550 and 650. And we rallied above 650 or whatever. There was a move. Okay. And so there was a move there. There was also bullish diversions bottom. And so when it broke out there. And, again, it's come back to the breakout. So that's something to look at now after taking some money off the table. So wheat's a good example.
Wheat would be one. This one, they are rolling. I'm assuming they are rolling futures contracts.
Yeah. So some of them aren't as efficient as like when you trade USO, it may not be as efficient. There's USL,
Correct.
which takes the 2 front months, but I don't want to make it complicated. I just trade what I see in the chart. I trade the chart. The underlying will take care of itself. At the same time, look at UNG, natural gas. Natural gas was at lifetime lows just a couple months ago. And guess what? We're having a hot summer. And we've had a tiny mini bounce. But put that in perspective. Go back to a 3-year chart and see where we were in 2022. Okay? Come on. Look at that. Natural gas.
Come on, people.
Natural gas.
In the words of
it's
Alan
like
Knuckman,
free.
come on, people.
That's like free. UNG. All right. Cocoa went from 2,000 to 10,000. So we're talking
I don't know
about
how
things
to do this. I'm going to see if cocoa just comes up.
There is not really an ETF for cocoa, but I'm just using
Cash
a commodity
contract.
as an example.
I'm not going into it. I'm not doing it.
Yeah,
That's
don't go
weird.
into that. But what I'm trying to point out is that these are markets that are not driven by opinion or earnings or whatever. They're not by rankings, by analysts and whatever. This is supply and demand, people. This is it. This is supply. This is demand. It is what it is. If there's less of a commodity, the price goes up. If there's more of a commodity, the price goes down. It's a lot easier to handle and to understand. The one I don't want to neglect is GDX. Go to GDX. Now, GDX are the gold miners. Now, we all know gold's at its highs. Finally, how many months did we talk about this in our meetings that we're like, listen, GDX is setting up. It's setting up because at the time it was making year lows, but gold was up there near its all-time highs. And I'm like, something has to connect here.
Yeah.
And it did, and it took off. Now, okay, but that's not over. If you look at GDX is at the halfway point of its all-time high. When you adjust for inflation, go back to that. It's at the halfway point. Okay, so there's still the miners still have a ton more potential. Look at that.
This is so all-time highs in 2011 up here in the 60 range. We're at 30.
And we're at 30 and change, right? Right? So, I mean, think about it. If gold prices go up, gold miners have gold. This is not, who has gold? Costco? All right, who else has gold? In the ground. Gold miners have it in the ground. All they got to do is take it out of the ground. It's that easy. They have it. They own it. So, that's something that you can't ignore. Just cannot ignore this.
Yeah, I did want to say
easier to understand.
Yeah, just a reminder on a few of these things, because you said I'll try and be quick on this, but like SLV and GLD, those are spot ETFs. And when you get into the WEATs and the UNGs, again, it has nothing to do with the price action here, but just knowing, and then again, Alan, I understand you're going to look at this chart, you're going to make your decisions on this chart and not worry about that underlying, but we have people on the call that might be buy and hold. They might not be doing short term. So they might see this ticker and be like,
this is all long term. This is the way to play long terms, is to trade these ETFs. I wouldn't say this, this is not the only concern. I don't like to bring up any negativity. The only concern if someone has a leveraged ETF, like you're trading a 3 times, the 3 times NASDAQ.
Yeah.
Okay. That resets itself. And that's a whole nother issue. These are the way that these work. If silver goes up, SLV is going to go up. If gold goes up, GLD is going to go up. It's not going to be precise and exactly like that underlying commodity necessarily, but that's what we're looking for. If wheat goes up, that wheat ETF is going to go up. That's it. That's it. Yeah. No, don't make it any more complicated than it needs to be, please.
I'm educating. This isn't complexity. This is education. But GLD and SLV, it's as if they have gold and silver sitting in a vault. They don't.
Do you want me to explain
why? It's as if they do. Whereas what wheat and UNG have are 3 rolling front month or the next 3-month contracts of futures options. That does cost money, and over time it rolls. So it's a little bit different. That's all I'm saying.
Okay. But let me tell you why. You want to know why? And I'll tell you exactly why. Because
there's no other way. You can't just sit a bunch of wheat. I mean, you should know, but you can't just sit a bunch of wheat in a silo and freaking invest it. Not going to happen.
You can. It can be in storage, and a lot of it is, and we can get into that if you want to dig in the weeds. But anyways, gold and silver are cost of carry markets. Gold sits in a vault, and it requires, storage and insurance, and that's it. That's how much it costs each month. So every month is exactly a certain dollar amount to the next month, to the next month, to the next month, to the next month. Because of that, there's no seasonals to it. It's not grown. Whereas corn, we plant the seed, nature grows the seed, we eat the seed. Okay, there's seasonal patterns. There's South America, there's North America. There's growing seasons. There's different factors. More corn comes in the fall. Obviously, December corn is the contract where they planted for it right now. That's the harvest it'll be for December. Yada yada. So those are seasonalities. But none of this matters. It's about what the chart says, and these ETFs are the efficient way to trade. And like copper doesn't grow on a tree. Copper's in the ground. So FCX is not going to move exactly like copper, but obviously they have other concerns. They, capital investment, they got to pay their employees and so forth, and who knows who's getting bonuses or whatever. But, it's going to move like copper. That's my job. I've been doing commodities for 35 years. So I'm just going to say, leave that to me. I know.
All right, look, this is one, I think you shared this with me way back in the day, but this is one that we might want to keep an eye on. This has nothing to do with the ticker, but it has to do with commodities, right? This is the drought
Yep.
monitor.
Oh, yeah.
This has no, right now, everything's hunky dory, but right in this general region, this is where all the soybeans and corn come from. If this little region starts turning this red color,
Yep.
you better believe WEAT, corn, any ETF that has to do with them is going to start moving because you get a little heat and you get a little drought. Commodity prices can start rolling there in the bread basket.
And
You follow this thing, right?
that's the whole point of this. Commodities always have, and I sometimes say always incorrectly, always have price pop potential. There could be a drought. There could be too much rain. There could be disruption. There could be the Mississippi River doesn't work anymore. It could be, what happens if there's a hurricane that hits New Orleans and that's where all the shipping for the grain goes to the rest of the world. There are so many things. There could be price pop potential. Natural gas is a perfect example. It could be too cold in the wintertime. It could be too hot in the summertime. Electricity. What about all these data centers? Where's all this electricity demand going to come from? Any disruption, okay, causes price pop potential. Who knows what could happen globally? All of a sudden, oil could be on the move again for any stupid reason. We don't know. That's not my job to know. And I've had this discussion with all our analysts. I don't care. Okay? I don't care. I will see it when I see it. I know it when I see it. And anything that disrupts the markets can cause a bullish pop. And that's what I want to take advantage of. You're not just going to find, 10 billion extra bushels of wheat one day. It just doesn't sneak up on you. But if there's a wheat bovel or something and it wipes out the crop, guess what? There's all these factors when it comes to Mother Nature. And that's what I take advantage of. I take advantage what the markets provide, and there's always opportunity.
That is, when it comes to the soft commodities or whatever, it's absolutely an asymmetric trade. You can't just make wheat out of nothing, but something can take all the wheat away real quick.
Yes, coffee. Drought around the world. Coffee is going to be a big deal. In cocoa, they just started. The cure for high prices are high prices. So when cocoa prices went to 10,000, they started planting more cocoa trees. But guess what? It takes 3 years for them to get to the maturity where they produce. So who knows what's going to happen in the next couple of years? So I can't say it enough. We could talk all day long about these individual commodities, but it's about the opportunity that exists out there. And when it comes down to any stock has an underlying commodities component. We could talk about interest rates. We can talk about gold. We can talk about oil. We can talk about, copper, aluminum, all of these, wheat goes into the food, corn. We made that list of 100 uses of corn. It was amazing. Some of the stupid stuff that corn goes into. Corn goes into drywall.
You're going to get me started, dude. And everyone, if you get me started on the corn lobby and what they're sticking corn into that they basically shouldn't. Now, I'm agreeing with your point, but I hate it. Why is corn in drywall? It shouldn't be.
Hey,
why is corn in gasoline? It shouldn't be. It's not at my house because I go to Pennsylvania and buy ethanol-free gasoline.
Like I said before, this is the best time in history. Don't be a hater. Be a profiteer. Profit.
All right.
Profiteer.
Speaking of profits. And profiteer. Let's talk Palantir.
Okay.
We got the chart up.
Palantir
I own shares in this one, so it should come as no surprise to everyone that I'm all pumped up over this stock. And so is Sean Ring. Sean Ring loves Palantir. Me and him just talk about Palantir for hours.
Oh no, I know. It's like trading porn for you guys. I send him charts and he just drools over it. All right. Go look at
what do we got here? What do you like here? Do you like Palantir at these levels? What do you got?
Okay, we traded Palantir in my service, made 100% a long time ago. Obviously, I wasn't expecting that gap, but Jesus, wow, it did. We made our money. Boom. It's reset itself, and you can see this big bull flag. And now, if you go to a 3-month chart, you can see that we're breaking out above the 25 level. Boom. If we break out above the 25 level, that target's 30. So it's like it's reset itself, and it's got some positive momentum. Never fight momentum. That's what I learned in physics, if nothing else. A body in motion will tend to stay in motion until it's acted upon by an outside force. And we've got this triple top here. So a lot of positives, and you can see where it had this strong bottom at that 20 to 25, a breakout of the range target's 30. So there's a lot of potential here in this. Limited risk options. I sleep well at night. I know you may be trading shares or out of the money options or whatever, but
Where, if you were to play on this one right now, like, is this, well, one, it's two questions. One, is this something you play right now? And then one way or the other, if you had to or whatever, what option price and what time frame would you be looking for on Palantir?
My rule is always to buy 3 months at a time. And so with 3 months at a time, sometimes you have to adjust. You can't go as deep in the money on something like this because it's got a higher volatility. I'm not looking at the volatility. And this is kind of, I can answer this. We actually have a 22.5 call that's coming due. We're about break even right now. So I got into it a little too early on this reset. And it rallied, but it never followed through. So now we're looking to see if it can follow through. But if you were looking at this, I would be, September options are 3 months away. So I would go at minimum September. 22.5 is the halfway point of 25 to 20. And you're going to be $2.50 in the money. And the rest is, time value. And if we get up to 30, that 22.5 will be worth obviously 7.5 plus whatever time is left. So, a modest move in the stock, but I mean, a $5 move from here is 20%. So it's a healthy move, but the options would gain 100%, would gain almost 200%. So, it's about the math. And like I said, it's as much of how I trade as what I trade. And so I think that's hopefully the lesson that people are learning today from me.
Yeah. Yeah, this one's looking good. I mean, again, I think Gunnar has talked about this as well. I mean, you definitely see this bottom there around 2021. Anytime it started getting close to it, the buyers came in. So there might be some institutions or just someone sitting out there that wants this thing, and it just took a couple resets here, and then we're back at 25.
And he's going to say the same thing I did, that look, he came back. See that gap back, that first gap and run? It came back to that gap. It came back to that support. Often stocks come back to the breakouts, but you got to be patient enough. And me buying it when you're at that 20 level, 21 level, the risk reward is 100 times better than buying now at 25. Not to say that it won't easily go from 25 to 30. I would never say not to do a trade, but I'm saying, the better trade is to buy it when it looks bad and lean on a level of support and then see how it reacts. Because once it reacts, and if we go above 25, then you're right. You're on track. That now it's just a matter of where do you want to get out and make money. Now you have to start thinking. What amount of money, works for me. And everybody's different. Some people like 20%, some people like 30%, some people like 100%. Everybody's different. But making money, it's what it's about. If you only made 10%, so what? You still made 10%. Okay. Don't beat yourself up.
And if you lose money, you better have learned something. That's the key. Right. So even if you lose money, you're a winner.
Right. Losing does not make you a loser. You followed your plan. And it's about probability. If you put yourself in the position for success, I got a 69.8% probability of success on my trades over the last 5 years. So, according to our math. And so it's about, you're going to be right more than you're wrong. This is not gambling. This is not Texas Hold'em. I hate gambling. I want to trade high probability plays. And if you're wrong, you're wrong. Like I said, you can put your stop loss at half of what you pay and salvage it and move on to a new trade. It doesn't have to be a zero. Again, if you're wrong, you're wrong. That's the first thing I teach new traders is learn how to take a loss. It's not personal. It's not the market effing you. It's just the reality. Learn to take a loss. That's it. And then then you're ready for a new opportunity.
Very well said. We got about 10 minutes here. We got to talk chicken at some point. We'll get to that in a second. In the chat, if anyone's got tickers in the chat, I'm probably going to find the, tickers that I see and I know just, because we're rolling on the fly here. Enrique was talking about this one, the CME Group. Anything, and Alan, I've got these up. I don't know if you just want to look at them, if you like anything on them, or if there's nothing to really be said here, but this is one where Enrique was thinking this might be setting back up. This is the CME Group. So you're familiar with the CME Group at least, but anything you like here or don't like on the chart?
Okay. I'm going to think. You're asking me to think. Okay, number one, if I don't know what this is, I like the chart. I like that level. It's coming back to that breakout from this way back when. You can lean on that level of support. It's tested that low from a couple months ago. If it rejects that, then I think there's some upside here. Now, it's a more expensive stock, so the in-the-money options are going to cost more.
Yeah.
But I think the risk rewards on the upside, and especially, again, if I think, and thinking gets me in trouble, if I think we're coming into election, there's probably going to be volatility, because right now everybody says there's volatility. Volatility is at a 3-year low, okay? We want volatility. Volatility is opportunity. Volatility means the market's moving. The markets are moving. It's our job to pick out a nice chunk out of the middle. We're not going to buy the low or sell the high. We're going to take a nice chunk out of the middle. Okay, so we want the markets to move, but we're thinking that the VIX volatility is at 12 or 13 right now. It could pick back up to 20. 20 is the forever average. That means there's more market movement. That means there's more people trading. The more market that moves, the more people trade, the more trades that go through the CME Group, the more revenue they get, yada, yada, yada. So that's if you think, but if you just look at the chart, I like this chart from a risk reward standpoint. You don't have to risk a whole lot. If it doesn't move up, if it doesn't stay above that middle low in the next 2 months, then get out of it.
Yep. Yeah, that's the kind of stuff that you like on a chart because it can be simple. Now someone's talking TLT.
Lean on it.
TLT, I hate it, but whatever. Let's get into this. I just have a vendetta against the stock, so it just is what it is. All right.
All right.
Anything TLT well? Anything you like here with TLT or nothing?
All right. I'll trade anything anytime as long as you control your risk. Okay, now to TLT. We've got to do some thinking here. Now, when I was a kid, when I traded on the floor, there was no VIX contract to keep track of volatility or fear, right? We would track what was happening in treasuries, and actually the 30-year treasury futures. So if the stock market was selling off, we'd look to see how much the treasury 30 years were up, because that was money coming out of the stock market going into treasuries, the safety of treasuries. Okay, so now we look at TLT, and if we look at the market in general, the 10-year note yield has come back down to 4.2, 4.3%. And I know Matt and I are going to have a discussion about this, but we're not higher for longer when it comes to rates. We're here for longer. We haven't gone higher in a long time. We're here for longer than we thought of because the economy's strong. And so, but if you look out to the futures markets, go to September of 2025. Are we in 25 right now? We're in 24. 25.
We're getting
By
there.
then, they're talking about rates being down at 4%. Right now, we're 5.5%. So that's 1.5% lower. So the rate cuts are coming. There's a 90% chance of a rate cut happening in December. So that's what the market's priced in. But, looking at this, I see a giant wedge. I see a giant wedge, a series of higher lows and lower highs.
Yeah, and it looks like it's doing a little action here on the coming out of that wedge too.
So at the same time, because the key for me is the dollar, and this whole conversation that we've had for this, however many minutes this has been, where I've been just talking over Matt, is
no, there was, let the record state, there's some people that are basically telling you shut up in the comments. So it's that's a status quo. That's normal around these parts.
I've got a little bit more to say than Greg. Greg's a good trader, but he's not as vocal as I am. He's not as animated.
Talkative. Loquacious.
Okay, so look at the dollar index. Okay, the dollar, all of these commodities have bounced, and the markets all made new highs with the dollar holding.
That's a 5-year.
Holding. It's holding here. Holding. So just imagine if the dollar starts to go down, that helps everybody. That helps every asset. So that could be the tailwind that we need for crude oil. That could be the tailwind we need for gold. We haven't seen like a fire up gold move. This has been a sleepy rally in gold. Okay, we haven't seen fire up moves like we could if the dollar starts to decline. If the dollar goes back below 100 and the euro currency goes back above 110, boom, boom, baby. It's going to be boom out there. It's going to be gangbusters.
All right, we got to do this one. This one's, I think we're going to run out of time for tickers, but we got to talk big one. This is Bitcoin. So Bitcoin has been, I mean, sideways. You got the ETF, then you got the halving, sideways. And now we're not sure.
Right.
Sideways. Anything to do here?
That's almost the same pattern as gold. we've been trading sideways with the key level of support. If it breaks up over those highs, you take the distance of that range on that top, and that's the upside target. So yeah, I'll trade anything. Now, I will be honest, I was not a Bitcoin believer 20 years ago when I should have been, okay? Because it wasn't an exchange traded product, and you couldn't.
There was no Bitcoin in the year 2004.
I don't know. When did it come out?
Like
2009?
2011.
Okay,
I don't know.
Okay. So anyways, I wasn't a believer. Not to say you can't make money. It was a gamble. And I didn't want to trade a gamble because you didn't have counterparty. You couldn't control your counterparty risk. There were different exchanges with different prices. I didn't understand, yada, yada, yada. But now that we have futures on it and then we have ETFs on it, hey, it's just like anything else. I don't care what I trade. It's how I trade. And I think this could be set up as well. There's a lot of upside momentum potential in this. And, I'm not here to judge. I'm here to make money. And, okay, throw up one more so I can finish with a commodity. Right here, I see a boat going by. Let's look at CLF. Iron ore, people. That's what built America. The Industrial Revolution wouldn't have happened without the iron ore that was found right up the road a piece.
All right, that's a 1 year on Cleveland Cliffs.
Right. So we're coming back down, but there's still a gap up above. Look at a 2 year on this and see how that support level. And I'm still going to start looking. There we go. So you can see, there you go. You can see that we're coming to a super bottom. Okay. And again, the thing about commodities, not only is the supply demand, they're real assets. Okay. These people have iron ore. They mine iron ore. That's what we have up here. This is the mine. The Native Americans found iron. They started this mine. This is the iron that they ship down to the steel mills. They make steel out of it. They make iron ore. They make railroads. They make steel for buildings, and they make steel for cars. That's what's built America. So this is a hard commodity. But look at that range. It's been trading in a wide range for this time, and we're down here on the lows. So I'm going to be looking to see what the sentiment looks like when we get down to that bottom once again and see if it tests and rejects it. And again, I'm looking at maybe some 6-month options on the upside. So stay tuned. That might be a trade very soon in the profit wire. That's what I'm keeping an eye on.
And that's a good setup. Like if I were to try to guess what one of your wheelhouse trades are, it's a lot of these $10 to $20 stocks because they're nice and optionable. You've got good movements. This is obviously a good trader because you can get a move to 22, in a relatively quick
and there's a gap
here.
Up above. There's a gap up above that probably will get filled at some point. Yeah. So, that's like a magnet. That's like a magnet for the market.
Yep.
Get it? All right. Iron ore magnets. Get it?
Here we go. And you don't get me started because in Baltimore, that bridge, again, we had the bridge collapse or whatever. I think the news just came out. They're like, it's a six years.
6 years till it gets fixed? Well, guess where the
iron America, we were like, let's put a man on the moon. Why don't they just say, why don't we build a bridge in 2 years?
I could get you some iron ore pellets right now. I'll send them to your house. You smelt them down. You make the girders, and you can help them out. Okay. I got access. I got supply, demand. I got plenty of supply right up the road a piece.
I'll call my people. All right. We got to talk chicken ribs. Alan owns a company. It sells a special cut of chicken. Tell us about this meat, and it's lunchtime. Bad idea for everybody. But where we're going now has nothing to do with publicly traded stocks and options. This has to do with a man's business. You've been on QVC at some point in time. What you fed the Green Bay Packers? What was it?
Yeah, so I developed or created a chicken product. Now, everybody's in the recent last 5 years or whatever, they've been looking for alternative proteins, right? And there are Impossible Burgers and yada, yada. But reality, the truth be told, that those are processed foods that have, 36 ingredients and actually more fat than an actual hamburger. Well, anyways, before that, I had come up with on my own, and then I realized there's a market for it. I spent some time in Texas, and in Texas, everything's barbecue, right? They don't care whether it's chicken, beef, or pork. They're like, let's go get barbecue. So I took that mentality, and I was eating a lot of barbecue and drinking a lot of beer, and I was starting to gain a little weight. So I took that mentality because I'm a chef. That's one thing that relaxes me with all this stuff going on, right? And I created a healthy version of barbecue. So I took a special cut of chicken, I smoked it, I put a Texas dry rub on it, and it's healthy barbecue. There's no fat, there's no skin. It's chicken on the bone. It's a chicken thigh technically, and it's cut like a rib, and then it's slow smoked with hickory wood. Then I realized there was a market for this. People want pure protein plays and they want healthy barbecue. Everybody loves barbecue, but not everybody has the time to spend 4 to 6 hours, smoking their own stuff. So I've
Shameless
produced
plug.
this.
Now, again, Paradigm, I have no stake in this game. And Alan didn't ask me to do this, but I've had the chicken ribs and they're good. Now, I would argue they might be, I mean, they're pricey because you get what you pay for. These are good. So if
Right.
anybody wants it, what is this website? Chickenribs.com? Is
So
it?
that chickenribs.com will go to the website. You can send me an email, but I sell them on QVC. And that's an outlet right now. I'm working on getting in some retail outlets and so forth. But
YouTube.
so the idea
Look at
is
this.
healthy barbecue, rain or shine, it's healthy barbecue time. So it's already fully cooked. All you do is warm it up. So that's the beauty of it. Like I said, I stumbled across it, checking on corn prices, realizing the profit in the chicken business. And by going to the national chicken conventions for commodities, they were looking for new products. They're always looking for new products. And back in the day, they used to take chicken thighs and just give you further information. America is the only country in the world where we prize breast meat over dark meat. So we would ship our dark meat around the rest of the world, send it off to Russia at bargain basement prices, because the housewives in America, they want chicken breast. Chicken breast does not hold a flavor profile. No matter what you do to it, it still tastes like chicken breast. Chicken thigh, for any self-respecting chef, that's the cut of meat to use.
Chipotle.
And a leg.
They
But
use the
yeah,
thigh.
Chipotle, that they use thighs. Right, there you go. So they use thighs. So there you go. So I take the skin off it, I trim it, so you eat it around the bone like you'd eat chicken, like you'd eat ribs.
It's a single bone. It's like a chicken with a single bone on it, and it's
a handle.
It's not the ribs of a chicken. Just FYI out there in America.
Well, I know. Sometimes I have to explain to people the ribs of a chicken would be tiny. Okay, so it's a chicken rib because it's like eating it's the process of eating a rib, but it's using healthy chicken, so there's no skin, no fat. It's ready to go, and it's just heat and eat. So it's a convenience product, and it's healthy, and it's something it's been fun for me. I've been on Bloomberg with it. I've been on Fox. I've been on, like I said, I sell on QVC. I've been on a lot of TV stations. So it's a nice, fun side project for me. And maybe we will go public with it, Matt. And we're doing other flavors. And, then we'll be able to talk about the chart. I won't be able to talk about the chart, but someone will.
All right, here we go. I'll do a quick rundown. I'm just going to rattle some tickers. These are the ones we talked about. We'll call them top trades, whatever have you. We talked about SLV, Silver Trade, FCX. That's Freeport McMoran. We talked about Schlumberger, SLB on the oil services. Talked about wheat, and in general the commodity complex. What was Cleveland Cliffs? What is that? CLF.
CLF. That might not be ready yet, but let's keep an eye on it. That may show up in our service very, very soon. So very soon. But the idea is that commodities have the best risk reward right now. I mean, I'm not trading them because just I know them and it's my life. I'm trading them. You can look at all the companies we made profits on in the last years. A lot of tech stocks, a lot of other stocks, a lot of China stocks, a lot of technology. But the risk reward is not there any longer. All right. So you got to trade where the opportunity sits, and I think the opportunity sits. And hopefully, I made a case for it for people that want to think. Like I said, I trade the chart, but if you want to think it through, the dollar declines, every commodity goes up.
Yep. All right. Very well said, Alan. Thank you so much stepping in. Gunnar was out this week. He'll be back in next week, but we'd love to have you back. I know you were here. It was the three of us on a call. And then I mentioned Enrique. I've said this a couple times. I've got to get Enrique on the call. We got a lot of stuff going on. And then as always, I'll say it week over week. I appreciate you guys. I had to have you on my cell phone today with all the comments and stuff because I can't do multiple things on my computer without screwing up the feed here. But I appreciate all the comments coming in from everybody, all the regulars throwing in tickers and the commentary and questions. So much appreciated to everyone out there.
I want to thank Greg.
World.
Thank Greg for letting me use his venue. And like I said, I look up to the way he trades. It's not the way I want to do it because it's a lot of work, but he's really good at what he does.
Yep. All right, everyone. Have a great weekend. We'll see you next week. Alan, thanks so much for your time. We'll see you next time.
Thank you.